Last week was a painful one for cryptocurrencies. Prices fell so hard that nearly $1 trillion in market value has been lost since the recent highs. So what happened to that trillion? Where did it go? A lot of folks find the answer surprising. Welcome. I'm Adam Taggart, founder of Wealthion. Last week, I published a short video titled, "What the heck just happened to Bitcoin?" explaining the sharp drop the cryptocurrency complex suffered following several crackdown announcements by China, as well as Tesla's rejection of Bitcoin as a form of payment. At the video's end, I asked for feedback on whether folks would like to see more of these kind of brief explainer segments that make sense of recent developments in the news or of an important concept of financial resilience. Well, the response was pretty darn clear that yes, you'd like to see more of these. So I'll start doing my best to pump them out on a regular basis. In today's video, I want to talk about a poorly understood concept called money heaven. What's that? Well, I'll get to it in just a minute. But to help set the context, let me give a quick update on what's happening with the cryptocurrencies. Last week was pretty darn lousy for the cryptos. China announced not once, but twice that it plans to curtail both coin mining and transactions within its borders in the immediate future. And piling on, the US Treasury strongly hinted that it plans to start taxing all crypto transactions over $10,000. By the end of the week, many of the cryptocurrencies were down more than 50% from their recent highs. As an example, by the weekend, Ethereum had dropped over 55% from its all-time high, which it had reached just 11 days beforehand. Bitcoin dropped as low as 31,000, prompting me to ask this question on Twitter. Is it time yet to start seriously considering that the recent Bitcoin price action is completing the classic rise and fall trajectory of all historic asset bubbles? And when you look at these two charts next to each other, folks, that's a pretty compelling question. Now, I'm not looking to pick a fight with the Bitcoin crowd on what Bitcoin's true value is. And I should mention that at the time of this recording, Bitcoin has rebounded up to 37,000. All I'm saying is that the price action trajectory of Bitcoin and most of the other cryptos increasingly resembles that of classic asset bubbles. And here's where today's theme comes in. When I mentioned that over $1 trillion worth of market value was vaporized during last week's crypto correction, I received a lot of questions wondering exactly where all that lost value went. Well, it simply disappeared, as billion-dollar fund manager Diego Perea, who I just interviewed yesterday, confirms here. In short, that $1 trillion of market value went to money heaven. When it comes to the financial markets, most people think there's a big pool of money sloshing around, flowing into certain assets, making them rise in price, and flowing out of others, causing them to fall in price. And that's largely true. But when speculation runs hot and money moves into or out of assets quickly, things don't quite work that way. And this is important because today, speculation is dominant in the markets, resulting in a record number of concurrent asset price bubbles. And bubbles inevitably pop. When they do so extremely fast, often resulting in overnight losses. And when those sudden losses occur, there are a lot of losers. But interestingly, there are usually oftentimes only very few winners. You see, many people erroneously think, well, if somebody lost, then someone else must have gained. It's a zero-sum game where it all evens out. There should be an equal number of winners and losers. But it doesn't work like that when a speculative bubble unwinds. When prices fall fast, all the tasty wealth that was there before simply vaporizes. It goes to money heaven. Let me use a simple example to try to explain this. Let's imagine a cul-de-sac neighborhood made up of identical houses. They all look the same, they were built the same year, and they're all in the same condition. Now, housing, like stocks, is priced at the margin. Now, that's an important investing concept worth explaining deeper in a future video all its own. But for now, just understand that the most recent property that sells in this neighborhood sets the market value for every other house. So if the most recent house to sell sold for $100,000, every other house in the neighborhood, since they're identical, is now also priced at $100,000. And with 10 houses on our cul-de-sac, the market value of the entire neighborhood is 10 times $100,000 or $1 million. Now, Assume a big company like Amazon announces it's thinking of building a new regional headquarters in town. Tons of new jobs are expected. A couple from out of town rushes to buy a house in our cul-de-sac. None of the residents really wants to sell, but by making a crazy offer of $500,000, the couple succeeds. That single sale resets the price for all the other 9 houses on the street. $500,000 times 10, or $5 million, is now the market value of the neighborhood. Wow! Just one house sold, and yet the value of the entire neighborhood quintupled to $5 million. That's some serious money. All the residents are now feeling flush with their good fortune. But then the news hits that Amazon ultimately decided to build its new headquarters in a different state. All those new jobs won't be coming to town after all. So the disappointed couple moves out, putting their new home back on the market, where it finally sells for $80,000. Now, the market value of the neighborhood has been reset again, this time downwards to $800,000, or $4.2 million less than where it had recently been. So where did that $4.2 million go? It went to money heaven. No one got it. It literally just vanished. The important lesson to learn here is that when speculation causes prices to rise faster than capital flows can justify, these prices are often unsustainable, even though during the mania, everyone assumes they are. Which is why so many people get shocked and burned when price bubbles collapsed. It's all winners on the way up and pretty much all losers on the way down. Yeah, sure, the shorts win, as do the very few lucky people who sell out before the cascade really builds steam. But these players are almost always tiny in number compared to the multitude of bag holders when a bubble bursts. So the lesson here is to look at your investment portfolio with a critical eye as to your exposure to speculative risk. Your stocks, bonds, real estate, cryptocurrencies, your business assets. What's the risk that a material part of the current assumed value of any one of these could quickly disappear given the current level of speculation in those assets? More importantly, what steps could you be taking today to reduce the odds of your wealth from going to money heaven? A few minutes ago, I mentioned the interview I recorded yesterday with Diego Perea. He's got a strategy for protecting against this risk by adding what he refers to as anti-bubbles into your portfolio allocation. It's a pretty fascinating approach. If that sounds interesting to you, be sure to catch the video with him when it comes out on Friday. And as always, if you'd like help in assessing your own current portfolio's risk, you can always schedule a completely free, no strings attached financial consultation with Wealthion's endorsed financial advisors. They'll review your situation and give you their best advice on any steps that they think you should be taking. To set that up, just go to wealthion.com and fill out the extremely short form there. Again, let me know in the comments below if you'd indeed like to see more of these shorter explainer videos going forward. And if so, feel free to suggest any topics that you'd especially like to see covered in the future. Thanks for watching.